Joining me now in a CNBC exclusive is Charlie Ergen. He's the chairman of Dish and EchoStar, and Hamid Akhavan. He's the CEO of EchoStar. Guys, good to have you both. Charlie, it's been a long time. I'm sorry we're not in person, but I'm certainly happy to see you. 15 years ago, you said, let me just look here, when you spun off EchoStar, that it would enable the companies to pursue the strategies that best suits their respective long-term interests. And allow employee incentives and the like to be tied to the company's performance. Now you're saying that it's compelling because it's all about growth and building long-term sustainable businesses. What changed so that you're bringing these two back together?
Well, good morning, David. And a lot's changed. And the biggest thing is we can really build we're really bringing a new athlete for telecom. And there have been a lot of technology changes since we spun off Dish. But there's a lot of companies that do satellite well. And there's a lot of companies that do terrestrial telecom well, but there's really not a company that combines connectivity in a way that you can use both terrestrial and satellite together. And with the advent of lower satellites and lower cost launches and the advent of 5G standards, you now can put all those kind of things together. So we built this athlete that has a tremendous amount of resources, whether it be worldwide spectrum, whether it be expertise in both telco and satellite, whether it be network management skills. That all comes together, and so while that didn't exist 15 years ago, obviously, when we spun the companies off, but now it makes sense to put them back together.
Charlie, what I hear from many of your investors, of course, is the continued question of how much capital you're going to need to be able to successfully build out your wireless business. And many would view this deal potentially under that perspective as simply giving you access to EchoStar's balance sheet. One saying to me, it's almost a disguised equity raise. How do you respond to those questions and or concerns?
Well, there's no question that this deal, one of the benefits of this deal is that it certainly strengthens our balance sheet. It certainly strengthens our runway for the next couple of years. But there'll be more to do on that. We know we have a lot of capability and assets, and we know that we have to continue to invest in the future. It's always a mistake for companies to not invest in the future because eventually that catches up with you, and we've been investing for over a decade in where we think connectivity is going, and I think that's going to position us well for the future. But certainly we're in a stronger position today than we were yesterday.
Yeah, but I mean, you spent almost $40 billion buying spectrum, and the question is, do you have enough money? You don't seem to have access to the capital markets, at least at a level you'd like to be able to borrow at, Charlie. I mean, Citi's saying you're going to need between $8.5 and $9 billion by 2025. What are you going to do to raise the capital to build out this wireless business that you spent so much money acquiring the spectrum for?
Yeah. Well, first of all, I think maybe the market doesn't totally understand the capital that we need. That may be partly our fault, but we have a tremendous amount of assets. The combination of the company allows us to grow parts of our business, and maybe Hamid can talk a little bit about EchoStar and some of the things that they're doing, because they certainly are cash flow positive, EBITDA positive, so they bring a lot of skill sets. But when you put the companies together, there are some synergies and there are some business opportunities that we otherwise wouldn't have.
Hamid, I mean, I will come to you. You're going to be running a company that's challenged, at least in some of the core businesses. The satellite TV business. I mean, you just reported lost 294,000 subscribers. I think you're below half of your previous size. EBITDA burden from the wireless build-out. Revenues running at a rate of about 8.6% decline a year. Your leverage ratio is 7.2. That's for Dish I'm talking about. So I don't know the combined company. What do you do here when you run this company? What's number one on your list of things you got to accomplish?
So, David, here's where we have technology meeting opportunity. I think we have a unique portfolio of assets here that provide us with almost any form of connectivity. We have anything from engineering and manufacturing and content delivery and mobile wireless. I think we ought to bring this together in a synergistic way. There's a lot of synergies that can be created as a result of combined operation, but more importantly, bring in products to market that are bundled properly. Now, there's 17 million households in the United States that do not have proper broadband connectivity, and that's a requirement to participate in digital economy. And we have 18 million subscribers that are spread across 3 or 4 different lines of business in the combined company. I think this opens a lot of doors for us to bring new products to market, to bundle products in the market and satisfy the needs of the consumers. So I expect to take advantage of that unique differentiation. I think, as Charlie referred to it, is a new athlete in telecom, and I think we're going to put that to use.